What's up, guys? General Grigori coming at you here. I just wanted to respond to a little bit of a video from Jeremy over there at The Quartering and kind of give you guys a little bit more information on his video regarding EA and Activision Blizzard and how their executives are reportedly selling off shares at advantageous times in order to take advantage of the market before their company's valuations fell apart. And so I get that, the sentiment of that we all want to catch these guys doing shitty deeds because in previous years, Activision Blizzard and EA have both done their fair share of shitty deeds. I mean, do you guys not have phones? Like, come on now. That kind of stuff, that kind of tone deafness, or, just don't buy the game then, bruh. Like, that kind of tone deafness, those kind of shitty deeds, microtransactions, shitty DLCs, killing off franchises, you name it, they've done it and brought it to market and tried to sell it to us. And so I get that there's a lot of hostility within the industry in order to try and catch these guys doing something they shouldn't, but unfortunately in this particular example, this isn't exactly the case. And so I wanted to kind of provide a little bit more information on what is actually going on and maybe, kind of clear a little bit of, what's going on and kind of show these transactions in maybe a bit of a different light. And so first I wanted to cut over here to the SEC Forms 3, 4, and 5, which were established by the Securities and Exchange Commission via the Security Exchange Act of 1934, which was established after the Great Depression in order to prevent these executives from doing shitty market practices and trying to get away with insider trading or using insider information in order to take advantage of the market. And so what the SEC has is Forms 3, 4, and 5. These are forms that these executives fill out in order to sell their shares on the open market. Usually they do these sales on a fairly regular basis, as we'll see in upcoming slides, if you will. I've got tabs, but, same difference. But you'll see here that we've got these fairly regular sales. They don't really have a lot of wiggle room, these executives at these companies, because if they sell off a huge block of shares, everyone on the market's going to be like, hey, what the fuck? Hello? Like, you can't do that. You can't just sell off when the market's good and take advantage of the fact that you knew your company's valuation was going to fall to pieces in 6 months. So what they do is, in order to get their fair value out of their executive compensation, they sell off shares in given blocks at regular intervals, and we'll go through that here. And I just wanted to touch on the fact that these transactions do look a little bit fishy from an outside perspective. So you see these buy, sell, 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 buy, sell, buy, and you just see these what appears to be executives flipping shares in order to take advantage of a favorable valuation, but that's not really the case. And so if we go over to the NASDAQ website, their transaction history gives us a little bit more information and can allow us to make a little bit more of an informed decision on what these guys are actually up to. And so you'll see that we have 4 major flavors of transactions. We have automatic sales, dispositions and acquisitions. These mostly are non-open market, which I'll explain that in a second, and option executes, which again I'll explain that in a second. So dispositions are executives selling off shares. Acquisitions are executives acquiring shares. Non-open market means that they are acquiring these shares before they ever hit the market. These shares are never actually listed on the New York Stock Exchange. These shares are usually one executive swapping shares to another, and EA has done that actually earlier this year, and we'll get into that in a second. Option executes are part of a executive's executive compensation package. And so what those are is, with a stock option, the executive has the option to purchase a share at a strike price, and that strike price is supposed to be below where the value of the stock actually is. And so what this creates is an environment that incentivizes the executive to drive that stock price up and make decisions that drive that stock price up, which is what gets people to buy into these companies in the first place, because EA wants its share price to be good, so that way it can have a good equity value and look competitive on the market, so people trust the brand name because their equity is worth a lot. And then they want to drive that share price up to give their investors value, to incentivize them buying into the stock. Because as an investor, you want to buy into that share at $60, $70 a share, and then sell it for $130, $140 later on that year, and get some crazy capital gains. But in this instance, it's more so like these guys are buying these shares, at like $20, $30 a share, and then being able to sell them at the market value. But they do it on regular basis. They don't just buy a bunch of shares and sell a bunch of shares flipping really quick, unless their automatic sales are set up to do so, which we'll get an example of that with Mr. Morheim here in a little bit. But to kind of show how EA does things, each company kind of does their own thing when it comes to when they swap shares around. But they want to get these shares distributed amongst their executives in order to match their executive compensation package. So you'll notice here with Andrew Wilson, the chief executive officer of EA, this is from their annual report of 2018. So this is 2017's financial numbers. But he received an executive salary of $1.1 million, stock awards of $32 million, and a total compensation of $35 million. And so that kind of shows the incentive to keep the stock price high, because 32 of 35 million of his executive compensation is based off that stock price. Only 1/35 of his executive pay is based off of his salary alone. It's mostly based on the share price, and you'll see that across the board with the other executives as well. 17 million of 19 million, 46 million of 48 million, 13 million of 14 million. And so that kind of shows how these executives are incentivized to keep their stock price high, because they can then sell out for a better price than that strike price, which is the entire point of their executive compensation. That's why these guys make money hand over fist, or godlike amounts of money, I think, as Jeremy referred to it as. So we'll notice here with Blake Jorgensen's transactions that he sells his shares in fairly regular blocks of 10,500, 10,500, 10,500 on fairly regular dates, being the 5th of June, the 3rd of July, the 8th or 7th of August, the 4th of September. And so we'll notice that in July, he sold his shares on the 3rd, right, which is the first Tuesday of a full week. In June, he sells off his shares on the 5th, first Tuesday of a full week. With August, he sells it off on the 7th, which is, I lost my calendar, the first Tuesday of a full week of business. And so these guys are selling off these fairly regular blocks of shares at the same point every time during the month. And that's so that they can still get a fair value for their equity, but not cause a panic and not take advantage of insider information, because they're selling these blocks at 10,000 shares at $118 a share, $135 a share, $142 a share. But then you'll notice he continues to do this regular sale even as EA's stock price starts to drop off. And so at the most recent sale, which these occurred on 2 separate days, but this is the first Tuesday of a full week after the market was closed over a weekend. And so these two numbers are also 10,500, just for clarity's sake. But they sold their shares, or he sells his shares, 10,500 shares at $85.25 or $85.02. So even throughout the entire course of EA's stock price falling to pieces, as we can clearly see via their stock price, they just closed at like $77 or something like that. But even throughout this entire course, he's still selling off shares. So he's not blatantly taking advantage of the high stock price. It looks like it because, he sells out at a good point here. But over here, he's not exactly selling out those shares. He could have held on to them, if he were a normal market investor, he would hold on to his shares at that point, or had sold a lot more than 10,500 here. He had 146,000 shares available to him to trade, but he only sold 10,500. If he sold anything more than 10,500 at when he had 146,000 at $142 a share, that would have raised a lot of red flags if you're at this point and he has 2,000 shares, he sells them all off at this point, everyone would be like, dude, like, we know you're insider trading. Like, everyone would catch on to that, but he doesn't do that. And so we can see that across the board with other executives as well. So we see that with Mr. Singh here. I cannot pronounce his first name. That is a little bit beyond my linguistic abilities. But he sells off blocks of 200 shares at regular intervals as well. He does his on the first available trading day of the month, unlike Mr. Jorgensen. He does his on the first Tuesday. It just is kind of whatever they want to do. They can declare a specific date to the SEC, and as long as it's fairly regular, the SEC is going to be okay with it. And so you'll see 200 shares, 200 shares, 200 shares, first of the month, second of the month, first of the month. Very regular basis here as well with Mr. Singh. You'll also notice the same thing with Andrew Wilson, the CEO. He sells them off at 9,000, 9,000, 9,000, 9,000, 9,000 block. He does a couple of 20,000s in here. I'm not entirely sure why he's doing that, but these are also pre-declared transactions, and he has a couple of irregularities. But for the most part, he's selling off blocks of 9,000, and he did blocks of 10,000 last year. You'll notice that he currently has 189,000 shares. If he had sold them all off here at $141, everyone again would have caught on to it and been like, dude, like, you're insider trading. We can catch on to that. And so the last example I wanted to pull up here was from Jeremy's video regarding Michael Morhaime and how he kind of keeps himself at a neutral basis when it comes to shares. So what we've got here is Michael Morhaime clearly has some options left over from his management days at Blizzard. And so he's choosing to exercise those options and immediately sell them. And I'm assuming that if you go back, he chooses to do that ever since he left the company. He might have done some other regular sales when he was managing, but in this specific instance, he keeps himself at a fairly neutral basis. So you'll see here we've got 4 different transactions. We've got 2 option exercises and 2 sales. One of the option exercises was at $26.93 for 5,875 shares. Another one of the option exercises was $30.01, 165,351. If you notice here, we've got 2 sales of shares where he's selling 5,875 shares at $71.03, and then 165,351 shares at $70.07. So he's keeping himself at a neutral, no gain, no loss of shares basis. He's just, when he acquires the shares, he immediately exercises the option and sells them on the market, as long as the option's obviously less than the share price, and this is going to be lower than the share price for the considerable future. Even though Activision stock price is falling pretty low, it's still going to be above $30, and I think it probably will remain above that unless we see some kind of really crazy recession here within the next couple of years. But I don't really see that being an issue. The point here, though, is that because of the difference between the strike price and the market price, you get this huge discrepancy. So you get him making $11,750,000 off of the sale of 165,000 shares. But he had to exercise that option and purchase those shares for $4.9 million. So he had to exercise his option in order to make the sale of these shares. So it wasn't exactly like an insider trading thing, because Activision stock peaked long after this too. And it would have been really suspicious if, after all this was said and done, if Michael Morhaime had sold off his 28,000 shares and been done with it at non-regular bases at the top of the market. Again, that would have been indicative of him doing something that would have been akin to insider trading, but that isn't exactly what's going on here. So I just hope that maybe some of this executive compensation information and such, and EA's transaction history sheds a little bit of light on what's going on over at these major companies, and that it clears a few things up and kind of shows that even though we want to catch them doing shitty things, they're not doing shitty things in this particular instance. So let me know if you got any questions down below in the comments, and appreciate you guys checking out the video. Hope you guys have a good rest of your day, and cheers.